Can you really retire in just 10 years by investing only $200 a month? It sounds like a dream scenario. Set aside a relatively small amount each month and become financially free in a decade. This idea is certainly attention-grabbing, and it's easy to see why. Who wouldn't want to work for just 10 more years and then live off their investments? Today, we're going to break down this intriguing question. We'll look at the hard numbers behind it, explore what kind of investment performance you'd need, and discuss real investment options that could help accelerate your journey. By the end, you'll have a clear understanding of whether this plan is realistic and what it would take to make it happen. First, let's clarify what retiring in 10 years really entails. Retirement means having enough wealth invested to sustain your living expenses without needing a regular paycheck. For most people, that requires a sizable nest egg. A common guideline is the 4% rule, which suggests you can withdraw about 4% of your investments per year in retirement without running out of money too quickly. Using the 4% rule as a benchmark, if you desire an annual income of $40,000 in retirement, roughly $3,300 per month, you'd need about $1 million invested, since 4% of $1 million is $40,000. For a leaner retirement income of $20,000 per year, you'd need around $500,000 saved up. Even a very modest income of $10,000 per year requires about $250,000 in investments. These figures give us a ballpark. Retiring in 10 years means that within a decade, your investments from that $200 per month plan should grow to perhaps a few $100,000 at minimum, unless you plan to live on an extremely low income. Keep these targets in mind. We're going to compare them to what investing $200 a month can actually achieve. Now let's do the math on investing $200 each month over 10 years. Without any investment growth, $200 a month for 10 years is just your contributions. $200 times 12 months times 10 years equals $24,000 contributed in total. Of course, the whole point of investing is that the money will grow beyond what you put in. Thanks to compound interest, your contributions can earn returns, and those returns can earn further returns. The rate of return you earn will make a huge difference in how much you end up with. Let's consider a few scenarios. Conservative growth, say 5% annually. After 10 years, your $200 per month investment might grow to roughly $32,000. A 5% annual return is akin to a cautious mix of stocks and bonds, or perhaps a high-yield savings toss CD approach. The result is only slightly above your $24,000 contributions. Moderate growth, around 7 to 8% annually. This is close to the long-term historical return of a well-balanced stock index fund, around 7% after inflation, or approximately 10% nominal before adjusting for inflation. At, say, 7% annual return, after 10 years you'd have around $36,000. At 8 to 10% returns, you might end up in the ballpark of $40,000. That's definitely more than your contributions, showing the effect of compounding, but it's still tens of thousands, not hundreds of thousands of dollars. High growth, 15% plus annually. Perhaps you pick some outstanding stocks or other high-yield investments and average an impressive 15% yearly return. Even then, after a decade, your $200 per month could grow to roughly $50,000 to $55,000. Let's put these numbers in perspective. Even in an optimistic scenario where your investments double or more, we are talking about maybe $40,000 or $50,000 after 10 years of diligent saving. That is nowhere near enough to retire for most people. For example, $40,000 invested under the 4% rule would provide only about $1,600 per year of sustainable income, obviously not enough to live on. So, on face value, the answer to our question is looking like probably not, unless you drastically redefine retirement. However, before we conclude, let's explore why it's so hard to reach a retirement-sized nest egg with that monthly amount in such a short time, and what it would actually take to do it. If you're getting value so far, do me a favor, hit like and subscribe. We keep sharing finance and wealth-building strategies like this, and we don't want you to miss out. The key factor here is time. 10 years is a relatively short investing horizon, especially for achieving financial independence. In the early years of investing, most of the growth in your account comes from your contributions, not from investment gains. With $200 a month, after 1 year you've put in $2,400. Even if your investments earned a fantastic 10% return that year, which is above average, that's only about $120 of growth on the contributions. You end the year with $2,520. The next year you contribute another $2,400, and now the pot is a bit bigger, so the growth will be a bit more. Compound interest is powerful, but it's slow to show dramatic results in just a decade. By about year 7 or 8 of consistently investing $200 per month, something exciting happens. The investment earnings each year can start to exceed the $2,400 you're putting in annually. For instance, around year 8, you might have roughly $30,000 saved in a moderate return scenario. A 7 to 10% return on that could be $2,100 to $3,000 in gains in that year, which is on par with what you contributed. This is the tipping point where your money is working as hard as you are. By year 10, perhaps the annual gain is larger than your $2,400 contribution. That's the beauty beauty of compounding. Given more time, the growth accelerates. The problem is that 10 years just isn't long enough for compounding to reach a high enough gear. Most of the hefty growth from compound interest typically happens in later decades, not the first. To really see $200 a month explode into a huge sum, you'd usually need 20, 30, or 40 years, not just 10. In fact, as a comparison, 20 years of $200 per month at moderate returns could accumulate around $100,000 to $150,000, a much more significant sum, but still below typical retirement needs. 40 years of $200 per month invested could potentially surpass $1 million, assuming strong average returns over the long haul. That's why starting early, in your 20s, and letting it grow till retirement age is so powerful. So if someone tells you just invest $200 a month and you can retire in 10 years, they're leaving out the critical context of investment growth rates and time. With normal investments, the timeline is just too short for $200 per month to realistically get you to a comfortable retirement figure. So what would it take to actually retire in 10 years on $200 a month? Let's play devil's advocate here. Suppose you absolutely wanted to reach $500,000 or more in 10 years starting from nothing, using only $200 per month contributions. What would have to happen? The simple answer is astronomical investment returns. We would need the kind of returns that are extraordinarily high and unlikely to be sustained consistently. Based on the math, to hit somewhere near $500,000 in 10 years with only $24,000 contributed, you'd need an annual return on the order of 40 to 50% every single year for a decade. That is an eye-popping rate. For comparison, the US stock market's long-term average is around 8 to 10% per year, and even very aggressive portfolios rarely average above 15 to 20% annually over a long period. Achieving 40% plus yearly returns for 10 years straight is extremely unlikely without taking enormous risks. We're talking about perhaps picking the next miracle investment. Imagine having invested early in a company like Apple or a cryptocurrency like Bitcoin and seeing massive growth. While those stories exist, they are the exception. Yes, there are asset classes and strategies that can yield very high returns in short periods. For example, investing in early-stage startups, certain real estate deals, or speculative assets, but they come with a high chance of failure or loss. For every one person who turned $10,000 into $500,000 with a lucky investment, there are probably hundreds who lost their $10,000 chasing lofty returns. In other words, high reward comes with high risk. If you try to push a $200 per month plan to insane growth, you could also end up with $0 just as easily as you might end up with your dream figure. The takeaway here is that there's no magic investment that guarantees turning $24,000 into $500,000 in a decade. If it were that easy, everyone would be doing it. For most of us, the path to retiring in 10 years requires not just investing wisely, but also saving much more than $200 a month, or having a lot of luck, which isn't a strategy. In fact, many people who aim for early retirement, say in their 30s or 40s, follow the FIRE approach, which often means saving 50% or more of their income and living very frugally. They might invest $2,000 a month rather than $200 to hit their goals in a decade or two. The heavy lifting in such cases is done by high savings rate and a longer time frame. Here are some real investment options for maximizing growth. While $200 a month likely won't let you retire in 10 years by itself, it's still a valuable habit to invest regularly. Let's discuss what investment options could make the most of that $200 and how they differ. 1. Stock market, index funds, and ETF. For beginners and intermediate investors, broad-based index funds or ETF, exchange-traded funds, are popular. They offer diversification across many stocks. For example, an S&P 500 index fund spreads your money across 500 large companies. Historically, stock markets have returned around 7 to 10% per year on average. Investing $200 per month in stock index funds is a solid long-term strategy. Over 10 years, you might see that approximately $35,000 to $45,000 as we calculated. If you continued for longer, the growth could become substantial. Stocks are volatile in the short term. Some years you'll lose money, other years you might gain a lot. But over decades, they tend to outgrow safer investments. For a 10-year window, you could expect growth, but you also have to be prepared for possible down years. In the best-case 10-year period, stocks could double your money or more. In a worst-case 10-year period, you might end up only slightly above what you put in, if, say, a big market crash happened in that span. So there's uncertainty, but for long-term goals, stock investing is generally the engine of growth. 2. Bonds and fixed income investments. Bonds, bond funds, or fixed deposits are safer, but offer lower returns. These might give you in the range of approximately 2% to 5% annually. In some recent years, high-quality bonds or CDs have yielded around 4 to 5% because of rising interest rates. If you put your $200 per month into something very safe yielding approximately 4%, you absolutely ensure your money grows, but after 10 years, you'd only have around the low $30,000 range. The lower risk comes at the cost of lower growth. Bonds are great for preserving wealth and generating steady income, but they won't turn $24,000 into a life-changing changing some in a decade. For someone trying to maximize growth in 10 years, an all-bond approach would be too slow. They are usually part of a balanced portfolio, but for aggressive goals, you'd lean more on stocks than bonds. 3. Real estate. Real estate is a favorite wealth-building tool for many, but with only $200 a month, your direct options are limited in the short term. You likely can't buy a rental property with that level of monthly saving for at least quite a few years. A down payment would require tens of thousands of dollars. However, one option is to invest in real estate investment trusts, REITs, or real estate crowdfunding platforms, which let you invest in real estate projects with small amounts. REITs trade like stocks and often pay dividends. Historically, real estate, both through property appreciation and rent, might give returns comparable to stocks, somewhere in the mid to high single digits, often with less volatility in price but additional complexities like property maintenance or sensitivity to interest rates. Over 10 years, a $200 per month investment in a broad REIT fund might yield a similar outcome as stocks, maybe a bit lower on average. Real estate becomes more interesting if you plan on reinvesting for longer or if you eventually use your savings as seed money for a property purchase. For example, after 10 years, you might accumulate enough for a down payment on a small home or rental unit, perhaps using that approximately $40,000 plus some leverage via a mortgage. That could potentially accelerate your path to retirement if that property generates rental income. But this involves taking on debt and is a longer-term play. In summary, real estate can build wealth, but starting from $200 per month, it's not a quick win. It's another steady approach that usually needs time or additional capital to really pay off. 4. High-risk, high-reward assets, individual stocks, crypto, etc. Some investors might try to supercharge their $200 per month by putting it into more speculative investments. This could mean picking individual stocks, hoping to find the next big tech superstar, or investing in cryptocurrencies, or maybe options trading, startups, you name it. It's true that these avenues have seen some people achieve explosive growth. For instance, a single $200 crypto purchase in early 2017 could have been worth tens of thousands a few years later. Stories like that grab headlines. But for every huge success, there are countless cases where people lost most of their money because the coin crashed or the company went bust. If you attempt this route, you must understand it's like buying a lottery ticket for your retirement. You might hit the jackpot or you might end up with nothing. It's not a reliable strategy for most people, especially beginners. If you do decide to allocate some of that $200 into high-risk picks, financial advisors would say only use a small portion of your money that you could afford to lose. It should never be your main retirement plan. Think of it as an optional, speculative plan. B. Caution is key. These investments require lots of research, strong risk tolerance, and even then, there are no guarantees. 5. Investing in yourself or a side business. This is a different take on investment, but it's worth mentioning. You might use that $200 a month to take courses, learn high-income skills, or seed a side business. For example, $200 a month could pay for online classes or certifications that boost your career, leading to a higher salary, which then allows you to invest more each month than $200. Or you could invest in starting a small online business, marketing a product, etc. The returns on investing in yourself or a business can potentially be much higher than the stock market. If things go well, you might dramatically increase your income. That increased income could then be funneled into investments to reach retirement faster. The risk, of course, is that not all such investments pay off. You could spend money on a business idea that doesn't pan out. But unlike blindly chasing a hot stock tip, investing in your own skills at least always yields the benefit of you becoming more knowledgeable. For someone serious about retiring early, increasing your earning power is often necessary so that you can save and invest far more than $200 per month. This approach complements traditional investing and can accelerate your journey. Since purely investing $200 per month for 10 years is unlikely to hit a true retirement nest egg, it's important to consider adjustments to the plan. Increase the monthly investment. The simplest, though not necessarily easy solution, is to invest more each month. If $200 grows to approximately $40,000 in 10 years, then $1,000 a month, 5 times as much, could grow to roughly 5 times that amount, maybe around approximately $200,000 in 10 years at moderate returns. Still not a million, but inching closer. To actually reach something like $500,000 plus in 10 years, you might need to invest on the order of $2,000 a month, which is $24,000 a year, if we assume decent growth. Not everyone can do that, but it's a numbers game. Higher contributions have a huge impact, especially in a short time frame. This might mean cutting expenses drastically or finding ways to earn extra income, overtime, second job, side hustle, so you can funnel more money into investments. Many early retirees dramatically simplify their lifestyle to save 50% or more of their income. That's the level of commitment often required to shave down the working years significantly. Extend the time horizon, if possible. Maybe you originally wanted to retire in 10 years, but if you realize that's too aggressive with your current budget, consider adjusting the goal to 15 or 20 years. Even that extra 5 to 10 years can make a world of difference because of compounding. For instance, instead of approximately save $40,000 in 10 years, 20 years of $200 a month could potentially get you above $100,000 as mentioned. It might still not be full retirement money, but it could allow partial financial independence or a very strong head start. If you're young, giving your investments more time to grow will vastly improve your outcome. Sometimes slow and steady wins the race. Maybe not in a decade, but perhaps in 2 or 3 decades, you absolutely can retire comfortably thanks to the seeds you plant now. Redefine retirement or financial independence. Retire doesn't have to mean never earning a dollar again. Some people pursue financial independence where they have enough investments to have choices. Maybe after 10 years of saving $200 a month, you won't quit work entirely, but you might have the freedom to take a lower-paying job you enjoy or start a small venture without worrying about immediate profit. Or you might be able to semi-retire, covering part of your expenses with investments and part with a bit of consulting or part-time work. There are creative ways to leverage a smaller nest egg. For example, accumulating $50,000 might allow you to take a year off and travel. Not permanent retirement, but a sabbatical funded by investments. It's not the classic retire forever in 10 years outcome, but it could be a meaningful life goal that your savings enable. So, can you really retire in 10 years by investing just $200 a month? For most people in scenarios, the answer is no, at least not in the traditional sense of a secure, permanent retirement. The numbers simply don't add up to a large enough portfolio. Roughly $30,000 to $50,000 is what you might accumulate in that time with typical investments, and that's far short of what even a frugal person would need to live on for decades of retirement. The only ways to hit a true retirement level sum in such a short time involve either contributing a lot more money, taking on unusually high investment risks, or dramatically lowering what retirement means. However, this doesn't mean investing $200 a month is pointless, far from it. If anything, this analysis shows the value of starting early and contributing as much as you reasonably can. 10 years of consistent investing builds a strong foundation, and if you continue that habit beyond 10 years, the compounding effect will become more and more powerful. Everyone starts somewhere. That $40,000 you might have after 10 years can grow to $150,000 after 20 years, and to over $1 million if you keep it up for 40 years. If you increase your contributions over time as your income grows, those numbers will look even better. The path to retirement for most of us is a marathon, not a sprint. Every single monthly contribution gets you a step closer. In summary, investing $200 a month is an excellent financial habit and will eventually pay off greatly, but expecting it to make you financially independent in just a decade is unrealistic for the typical investor. Instead of banking on a miracle, focus on what you can control. Save more if possible. Invest wisely in diversified assets. Give your money time to compound. Do that and you will set yourself up for a comfortable retirement. Even if it takes longer than 10 years, you'll thank yourself later. Remember, the journey to wealth is a gradual process, but with discipline and patience, you absolutely can reach your goals.